2019 before the pandemic. So it was perfect.
Good timing.
For pandemic
Did you see Peloton today?
No.
Wait, hang on. Just before we talk about Peloton down 20%, I tried to take a cold shower the other day. I couldn't do it.
Oh,
How do these people do it?
See, well, I like when
What's
I
the
come
big
up
deal?
north like this because I can take cold showers. I'm
Wait,
in
what's the
Florida.
big deal? Just turn it on cold and walk into it?
I slept in the city on Tuesday night and I had a terrible sleep. And so I wanted to wake myself up. And we had just been talking about a cold plunge the night before. I was like, oh, you know what? I'll try a cold shower. I was like, I couldn't do it.
What about, you could do it
hurts.
after you run, you could get into a cold
So
shower.
you could start the shower hot and then go cold and be fine. But getting into a freezing cold shower was not fun.
Yeah, I just finish it off like that. Yeah.
Peloton it's after a string of really, really, really bad performance, like a stock that's gone from 157 down to 6. Today it had one of its worst days ever, down 22%. It's a $4 stock. It's a $1.5 billion market cap. You could just LBO it right now for probably less than $2 billion. The whole thing. I don't think it's worth it.
I'd rather buy it than short it. Like, no question. Somebody will buy it. Nike, somebody will buy it.
I'd rather short it the next time it rallies. I don't know. Why would Nike buy it if they didn't buy it all this time? Has the brand gotten better or worse? What are they buying? They're buying a company.
There's $700 million worth of revenue, isn't there? It's not like nothing. I'm sure the guidance was horrendous.
It's expensive revenue.
It's a bike with an iPad, ultimately, right?
It's a bike with an iPad, and then they have like these trainers. And what happens when one of these trainers gets really famous? What's the first thing they do?
Ask for a raise.
See you later, Peloton.
Wait, do they have a lot of debt? I don't know.
I'm in business myself. What do I need this for?
Yeah.
Listen, don't go by me on Peloton. I'm just going to tell you one thing. There has never, ever been a publicly traded, fitness-focused company that has been a long-term winner on the stock market. And I don't count Lululemon.
I was about to say, but that's fitness adjacent.
No.
It's adjacent.
Very adjacent.
Yeah.
Never. And I've seen them all come and go. I was on the New York Stock Exchange the day not Peloton, Fitbit came public.
That was a disaster.
They set up a gigantic treadmill that like 10 people can run on at once in front of the New York Stock Exchange. I swear to God, on Broad Street. They set up this huge like spectacle. It was like the Trojan horse. Like they were about to wheel it into the building. And I just remember one after another. GoPro, I remember, which I think was kind of like a fitnessy,
yeah, I guess.
Sort of.
Yeah.
Town Sports, New York Sports Club, Philadelphia Sports Club, it's a chain of gyms.
Yeah.
Disgusting. Bankrupt. Bally's Total Fitness. I'm trying to think I can go down the list. I think Planet Fitness is okay for now. I wouldn't invest in that.
What's the reason for that? I've never really thought about it.
Because we're Americans, and in the end, we're fat and lazy.
How about this? 15% of the float of Peloton is sold short. So people are making money.
Planet Fitness has a $6 billion market cap. It seems okay, like relative to where it came public.
I mean, Peloton's just kind of. I guess it's just that's the trade right now. Is high quality, high quality,
the thing
short,
is,
low quality.
There's zero growth, right? Like they're not getting any new subscribers at this point.
It's worse than that, sir. There is a there's a secondhand market for all the shit people bought that they don't need anymore. So how are they going to sell new ones?
They're not.
Yeah, that's a really big issue and as for somebody buying them, I think Lulu bought Mirror, which was a competitor.
Oh yeah,
do you remember Mirror?
Yeah.
No.
Yeah.
It was like a screen you put on your wall, and it's a mirror, but then it delivers fitness classes.
Oh yeah.
I think they wrote the whole thing off already.
So gimmicky. I don't know.
Right.
I mean,
I think they wrote the whole thing off already. So I don't know who's.
I get a shock in the ear. Oh, look at Duncan rocking the F1 shirt. Is that
I like it. Duncan, can you explain the Ferrari news to us before we get started today? The stock went vertical. So
I was listening to the
Lewis
conference call and
Hamilton.
it sounded like Ratatouille was doing it.
who is Lewis Hamilton? Who is Lewis Hamilton to racing?
He's like the biggest thing in F1, in a
But
long
like
time.
of
The Kardashians
just
of
F1 or
F1.
like all of racing, he's like how big is he compared to
Well, F1 is the pinnacle
Earnhardt
of racing.
Jr.?
F1 is the pinnacle of motorsport, really, and so yeah, he's the biggest thing.
Wow, Duncan says motorsport. That's like is that like cinema for cars?
But isn't like Verstappen more dominant?
In the last couple of seasons, yeah. But Lewis won like what 7, 8 championships.
So he's like Kobe, like Lewis Hamilton is Kobe.
Is he American?
No, he's British. But yeah, he's going to Ferrari in 2025. I saw something earlier today about the TV time that Mercedes got because of Lewis being on the team. So this is big for Ferrari. I mean,
do you know how much market cap the stock just added on this news?
Earnings today.
10 billion or something.
Also earnings.
Yeah, they also had positive stuff.
Did you see the Michael Mann movie yet?
I heard it had a larger market cap now than Ford or GM, which is
I'm going to tell you, it's worth $70 billion Ferrari right now. And it looks like yesterday it was worth $60 billion. So they added $10 billion today on whatever the earnings announcement was, plus Lewis Hamilton.
You think Ford sells 100 times the amount of cars that Ferrari?
Yeah, I was about to say. They sell like 3,500 cars a year, right?
Do you want to know the market cap? Ford is 48.
But tons of debt, I'm sure.
Well, that's the problem. The enterprise value is much bigger because they're loaded with debt. Right. And GM is 45 billion.
We coming in hot? Episode 128. Every week it goes up by one more episode.
Holy shit, 128? Do you guys know that we have not just fans of the compound, but there are fans of different people and they kind of congregate together? And I learned today, there's a Duncan Hive. The people that are Duncan fans, they watch What Are Your Thoughts Live.
You started that, by the way.
Yeah, I know. We used to put you on screen. We don't do that anymore, but the Duncan Hive is still there for you.
Yeah.
Today I learned of the existence of the Bat Cave and Bat Boys. Alex told me he met a Bat Boy today. The guy has no interest in me at all and got to meet Michael Batnick and went crazy. How cool is that?
Batman.
So, shout out to all the Bat Boys out there. All right, John, you look like you want to get started. Let's go. What do you got? A hot date?
TCAF episode 128.
Today's show is brought to you by BlackRock. Digital asset adoption has significantly accelerated with Bitcoin as the leading crypto asset since its inception.
That's right, Michael, but for many investors, holding Bitcoin directly can be complex. That's why BlackRock launched iBit, the iShares Bitcoin Trust, an ETF that provides investors convenient access to Bitcoin. Here are 3 things to know about iBit.
Access. iBit enables investors to access Bitcoin within a traditional brokerage account, just like stocks, bonds, and other ETFs.
Convenience. iBit can help remove operational burdens associated with trading and holding Bitcoin directly, as well as potentially high trading costs and tax reporting complexities.
Quality. iBit is built by BlackRock, a leading ETF firm with expertise across ETFs and a history of innovation.
To learn more, visit iShares.com/iBit or discuss it with your financial planner.
Investing in digital assets such as Bitcoin involves significant risks, including possible loss of principal. For more information on the iShares Bitcoin Trust, including a link to the prospectus, please see the show notes.
All right, let's get after it. Today is going to be a great show. I'm so excited. We have with us a young man who is making his second appearance on the show. Absolutely crushed it the first time. We're so excited to have him back. He has traveled many miles to be with us here today, and you guys are in for a treat. We're all going to learn a lot.
This is going to be a long one. I'm predicting that we go 70 minutes, 75 minutes. We've got charts out the ass. You have a lot of, you are a chart man.
Charts out the ass. That's what we're going to call the episode, P.S. Nick, what do you think? Love it, right?
Warren, can
I do my, let me say who's here.
Listen, I was waiting for you to get into the doc.
Okay. Ladies and gentlemen, Warren Pies is the co-founder and strategist at 314 Research, an investment research platform that provides weekly insights, asset allocation frameworks, risk management, and more. Welcome back to the show, Warren. We're so happy to have you.
Thank you for having me. It's great to be back.
Warren, I was reading your latest, not the Q4 Outlook, the one that you put out in January. I forgot what the title of it was. I love all your quotes and stuff that you throw in there. It's like super sophisticated. I was having trouble keeping up with all like the QAR stuff. Who's the audience for this? It's hedge fund managers and
our core group is global hedge fund the global macro hedge fund managers. So, I mean, that's the community that we serve. We do, I hate to I don't want to exclude anyone because we do have I would say sophisticated RIAs on the service. I mean, I think you could easily be able to handle our stuff. So, I mean, RIA audience is a big constituent. Family office. We also have, my background was in oil and energy. So we have some oil traders and corporate hedgers and stuff like that. I usually don't say the types of clients or names of clients, but like Heineken, I know that they're cool with it, is a client on that side.
Very cool.
And so it's an institutional product.
How big is the universe of global macro hedge funds?
It's weird because it seems like there's a consolidation into these pod shops, and then you have
they're all at Millennium. They're all at Millennium.
Yeah.
Right.
But there's still a good roster out there, and the ones that used to exist, if they get frustrated with outside capital, they just turn into family offices, and then
they still want the research because they're still trading.
Yeah, same difference.
What's the difference between the work that you do and your partner Fernando?
Oh man, Fernando is back end, and I am kind of trying to piece the story together, And so I started out at Ned Davis Research, like we talked about last time, and building charts, doing studies, building models, and I think you learn a lot that way. But at some point, you have to kind of you can't do everything all the time. So at this point, I lean on him, and he's way more. He's much faster than me at putting together those studies and things like that.
So if you want to test something, you can fire up Fernando. And then the two of you can look at the results that he's come up with and try to figure out what it means.
He's like our Majuli.
Yeah, I can peck away at a Bloomberg or Python myself, but compared to him, it feels like a waste of time. So if it's anything sophisticated, like some of the stuff we do is the thing that's great about Fernando, he is like our secret weapon. I know he's supposed to be here, but I can give him what I think is the most complex study, and he'll turn it around. And if he's dialed in, he'll turn it around within an hour. It's crazy.
Shout out to Fernando. Well, we read all your stuff in preparation for today, and I actually had to turn it over to Michael because a lot of it was over my head. I think I have but you're going to explain to me. So today's going to be, I'm going to learn as much as the audience today about your outlook and what you think is going on right now. Want to play something. There was a little bit of news this week, you could say.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rents. So, of course, we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation. So the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time. But it may well have some more time to run. The supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still.
Who was that, Lewis Hamilton?
And that, of course, is Kansas City Chiefs head coach Andy Reid.
Why won't he just say it?
All right, so here's my take on this week, and I want to hear you react to it. Basically, it seemed like Chair Powell expected somebody to ask about March explicitly, and no one did, and he kind of got annoyed, and he was just like, the meme where it's no one and it's a blank space, and then whatever the response. So he just so somebody was like, Chair Powell, thank you so much for joining us. He's like, listen, I'm not cutting in March.
Yeah.
If you take nothing else away from today, that is the headline that should be in the Wall Street Journal, the New York Times, Barron's, Fortune, Forbes. Not cutting. I told you I'm not going to cut. We're probably not going to cut. Now, they'll probably cut anyway, because somebody asked about a 75 basis point rate hike in May of 23. And he's like, we're not really thinking about that. And then A week later, he did 4 of them.
Wait, you think he's cutting in March? They're not cutting in March.
There's still a 40% chance based on traders. People think that it's possible. Understand something. You have 2 more employment reports between now and then. One is tomorrow. And I think 2 more PCE reports. It's a lot of data. I'm telling you, it's not off the table.
But there's not going to be any surprises in the data. He knows where the data is going. It's trending in the.
He doesn't know shit.
Yes, he does. What do you think? It's enough of us.
If
Warren.
we've learned anything at all about the Fed, is that they know absolutely nothing more than anyone else that's about to happen.
It's kind of a do as I say, not as I do type thing too. I mean, do as I say, do as I do, not as I say. I mean, he's been saying one thing and doing another for quite a while now. So I think the market is kind of catching on. So you saw that cut probability for March, it collapsed and then it rebounded right back up to like 40%. I personally think they cut in May.
And
yields
yields came down.
Exactly. Well, yeah, and you also had the bank failure or bank problems
Right, sure.
yesterday. I think that was a little bit of a knee-jerk reaction, and there was also Treasury refunding, and so I think we got through a bunch of potential hiccups for the bond market, and then you saw people flow into fixed income, and so that was kind of that's how I justify or rectify all that price action. But yeah, I think they cut in May. I think it is data dependent. I don't think
you think March is like totally off the table,
no,
or it's still in play?
No, I think it's like, I think the market's priced about right, 40%.
So Warren, we do this thing in the media. I listened to the whole call yesterday, and I almost never do that. Never at one point did he say March is off the table. What he says, it's not our base case. But again, there's 2 months to go. We did the same thing with Zuckerberg. All the headlines are Zuckerberg apologizes for social media impact. Not even once did he say I'm sorry or apologize to anyone. I actually listened to what people say. So I don't think it really matters if they cut in March or May, quite frankly. Apparently it matters to some people involved in NASDAQ stocks, or it matters to a few algorithms. Do you think it's like so meaningful, the timing, or not really?
If I think that the fact of the matter is they're on the case, and they've switched from the way we've described it. They've switched from a nominal policy regime to a real policy regime, and that was the big switch that happened last in December. And they're on the case, and they've already said. So the big news takeaway yesterday was we're not thinking about any more hikes. We've already kind of taken that as a given, but that's big news.
In real terms, they're tight.
They're tight in real terms, and that's how they're looking. I mean, Waller has said that. John Williams said that starting back in August. Then Waller said it in November, which I think was the key tell. And Powell basically said that in December. Now, I think the financial conditions, stock market, things like that got ahead of itself, and he wanted to just kind of push back a little bit. It worked for like one day, but here we are right back at rallying again today. So I think it's coming. I think that kind of the core thesis for us is that the soft landing required 3 things: a resilient economy, rapid disinflation, and a hyper-reactive Fed. And we were pretty confident. And if you go back and look at the last time I was here in 2022, I said, I think we'll get these first 2 things, but I'm not sure about the Fed. Well, the Fed is now proving to be hyper-reactive. Despite whatever Powell said yesterday, they're going to cut. That's the bottom line. March or May, they're cutting.
Do you understand this mentality out there? Like, oh no, the economy's not bad enough for the Fed to cut in March? Like, what are these people thinking? I don't understand. I really don't understand the rationale. Why would the bulls want them to cut sooner than later?
I mean, I do think there's a nervousness around the labor market, because the labor market is it's loosening, and right now it's
wobbling.
It's a benign loosening, as I would call it right now. But I think they're just nervous that if you push it too far, but ultimately
it could feed on itself.
Yeah, I don't think 25 basis points, 60 days of 25 basis points of cuts isn't going to make a difference. If the economy goes into a recession, it was going there anyways, and if you look at the history of recessions, usually it's an external event that pushes it over the edge. So I don't think it's going to be that the Fed waited 60 days.
Yes, yesterday the stock market, Callie Cox tweeted that it was the worst Fed day for the stock market since March 2023. It was the worst day for the stock market since September. Big deal. The market's gone straight up for the last 3 months. Heaven forbid it falls 1.5% for a single day, which, by the way, we took it all back. Market got back all of those losses.
You know what else was happening in March of 2023?
Regional banks.
Like a literal bank panic.
The other thing, but I wanted to ask you, so the stock market responded for one day, big deal, took it all back. The bond market, though. So they're saying that we're not going in March, and the 10-year said, I don't care. Like, did the 10-year, how many cuts is the 10-year pricing in, now down at 386?
Yeah, I mean, I personally think that the 10-year is fully discounted a cut cycle at this point in time. And so to me, stocks are more attractive than bonds. And if you think about it, and that's been one of the hardest things as an allocator is that stocks and bonds have been so connected since second half of last year. And so really stocks they're two sides of the same coin. But when I look at bonds and you think about the 10-year, usually it trades at about a normalized spread of about 120 to 40 basis points over the Fed funds rate. So then you look at the Fed's dot plot and what the Fed's saying. They say they're going to take rates down to 2.5% when everything's said and done. Here we are at 3.8, 3.9%. The 10-year is already at its normalized premium to Fed funds rate. If the Fed goes all the way back to 2.5%, I'm kind of skeptical that they get back to 2.5%. I think 3% terminal rate makes more sense.
What would stop them from getting back there?
I think that inflation. So this is where we get into. There's like art and science and investing in market research and things like that. And there are these kind of like strangely emotional debates that you can get into. I think that inflation is probably going to be higher as you go out into the out years. Now,
higher than what? Higher than the last 15 years?
Higher than it has been post GFC. I think we're in a different regime.
What does that mean? 3%?
Let's just put it this way. The Fed struggled to get inflation up to 2% for like 15 years, and they're going to struggle to keep inflation below 2% for the next period.
Okay.
And so
what do you think is going to drive it?
Well, everyone talks about globalization rolling back and just incrementally. I think there's some truth to that. So that's a dynamic.
Reshoring or
makes everything
more expensive.
Right. I think a little bit of that, but I think that's a little bit more story than fact, to be truthful right now. I do think that energy costs are going up. The shale revolution was a huge tailwind. We have this chart that we showed years ago. It's the price of oil and CPI, and we would do CPI versus the 2% target as a trend line. And you could see that CPI really fell off that 2% trend line target as soon as oil collapsed in 2014. Yeah. And that was because we had the price war with the Saudis and U.S. shale. So shale, I think that added a big disinflationary tailwind. It's going away too. That's not going to be with us for the next 10, 15 years. But more importantly is, we added so much debt. We printed so much money.
What if I inject? All right, we lose the disinflationary impulse from the Saudi versus shale race to zero.
AI,
but AI.
I knew you were going to say that.
Well,
yeah,
we're very predictable.
I mean nothing if not predictable.
So no. The truth is, I don't know.
Yeah, no one knows. But
and inflation's like impossible to predict beyond like 9 or say 10 months out.
We still don't know what causes it. There's no textbook that says this is what causes inflation that everyone agrees to.
The Fed looks at the Phillips curve. If you do any kind of analysis of labor market inflation, there's like almost no relationship there. It's like, you're grabbing the 70s and then extrapolating it out to a whole bunch of decades where it never worked.
Why is debt inflationary?
That's my personal theory. I think that we basically think that's real money. Like the Fed did QE and lowered interest rates, and that's like they shoved reserves into the system. They basically changed the duration of the money outstanding. But when the government spins into existence in a massive deficit spending, pro-cyclical deficits like we've never seen before, this is the thing that we've all underestimated this cycle. When we talk about why is the economy so resilient, we raised rates 500 basis points and we haven't gone into a recession. Why is that? It's because we're doing fiscal stimulus now. We're running pro-cyclical deficits like we never have before, and none of us have properly accounted for how powerful that is.
Well, Sean just shared a chart with me from Apollo. 89% of consumer debt is fixed.
Yeah, but it always has been. Like, when was it not fixed? They've turned.
But it's a lot more than it used to be.
Is it though?
Same thing with S&P 500 companies. Way more fixed than floating.
So, in your point on that is just that why would that stop us from having inflation? It's more. It makes the.
No, I'm saying that one of the reasons why all of the interest rate hikes didn't impact the real economy the way that we would have thought in a textbook is because 2/3 of homeowners don't even have a mortgage, and the S&P 500. There was more bond issuance in 2020 than ever. It was like a crazy amount of debt issuance. So, yeah, rates are higher. Obviously, that impacted Russell 2000 companies, which we're going to talk about and you have a chart on. But I think that's why.
The bottom line is, right before we embarked on this massive deficit spending and spinning up all these dollars, the number one selling economics book in the United States, maybe in the Western world of 2020, was The Deficit Myth.
Yeah.
And The Deficit Myth is the story. It's Stephanie Kelton.
Tough timing.
Tough timing, but it's the story of why there's no such reason that we should ever hold back from spending when we need to spend, so long as in periods of surplus, we raise taxes on the wealthy to offset all that spending, which of course we'll never do. So I mean, there's a million reasons why like that idea is now funny, but that was the book that everyone had on their nightstand in the policy world. And now, 3 years later, we all know, oh, wait a minute, there is a limit.
No. I think she got a raw deal because we don't know, because absent the supply chain disruption, we don't know.
Well, I think that would you really say that inflation was all supply side?
I wouldn't.
No,
So-
but I'm saying we don't know how bad it would have gotten if we sent checks.
All right, let me ask you this question. The fiscal package that Biden did a month after being inaugurated.
Disaster.
That's over $1 trillion in public works projects and all sorts of giveaways and gimmies. And had we not done that, does 2002 end up as disastrous inflation-wise as it probably not?
No.
Like working backwards, what are the things you would take away?
Well,
that would be one of the first things. That's fiscal. That's not Fed.
My point is this. The next time we get a recession, I think it makes sense to send out checks. Maybe. However, it will never happen because the last time we did it, we got so much inflation. But there was also the economy was turned
But it's
on
not
and then
just
turned
monetary. It's the combination of fiscal and monetary and the collapsed time frame in which they did it all.
I understand. My point is, I think that fiscal stimulus can fix a recession or end a recession way more effectively than monetary policy. Do we agree on that?
Absolutely. So I am not like a MMT basher. Like I trade DMs with Warren Mosler, who I think is basically the godfather of MMT. And this was after the GFC. I had a mental model that was wrong when we went through the GFC. I expected QE to cause inflation back in 2008. So I went down an
You're the
MMT
only person who
rabbit hole.
ever said that. Everybody thought that. But I haven't heard anybody say my mental model was wrong. I thought QE was inflationary, and then I changed my mind. People are still saying it.
If you're still saying that, then you really haven't. You're not introspective enough for this game. You know,
if you are still saying what
that QE is inflationary,
that QE is inherently inflationary in a vacuum.
You know,
with nothing else.
credit to Mark Dow and Cullen Roche especially, who were saying this in 2010.
Cullen was instrumental for me. You know, he wrote a paper called MMR, and then I read a book from a professor named Randall Ray, and I passed that book around to people at Ned Davis Research, and it was all on MMT stuff. And I think they have a better mental model of the world. I think their policy prescriptions are totally divorced from reality. Cullen's great on this because he understands how the world works, and then he also can.
Yeah, the
understand
MMT people don't love him because he injects like the realism of why a lot of this stuff can't work in practice.
They're smuggling some of those, like Stephanie Kelton is. I don't know her, but she's smuggling politics into economics, and everyone on the right does that. The left does that, and honestly, I'd rather just try. You need to just in this world
for the audience, Warren. MMT in a nutshell. I know it's not easy to nutshell it, but
it was what spending doesn't cause inflation.
It's more or less saying that the government. It's kind of like chartalism. Chartalism is that the government spends the money into existence, and taxes are only used to create demand for that money. And basically, the Fed and the Treasury are all one entity. And what the Fed does
taxes
is
create demand. How? Because
once you like Warren Mosler has a little, and because I'm not great at doing these things, but Warren Mosler has this little thing where he locks everybody in, goes to like a college classroom. He says, okay, if I have a guy with a gun, lock you in here. I hand out Mosler bucks, and I have a guy stand at the door, and he locks you in here. And I tell you, the only way to get out of here is if you're able to give me X number of Mosler bucks. All of a sudden, I've created demand for those, and that's
so they'll start trading with each other.
They start, ultimately
they'll start wheeling and dealing, and that's what spins an economy into life is the need to pay off taxes.
But speaking of politics, I guess my point is that we've learned that fiscal stimulus is much better medicine than monetary. But the point is, politicians will never send checks again because of how disastrous this cycle was.
And they won't talk about Russia, Ukraine.
And they won't talk about the supply chains. They'll just remember stimulus, inflation. F that, never again.
Yeah, and I don't want to go too far down the rabbit hole, But
I would say we're there.
okay,
We're in.
Yeah, I mean, if you look at just the, you can tell it's more than just a supply side thing. And Governor Waller said this here recently. If you pull up just a chart of CPI and you draw a trend line through it, and we bounced way off trend during this, and if you think about it, if we just had a supply issue where supply chains were shut down, but we didn't spend all that money into existence, prices would go up, it would cause a recession, and you'd go right back down and you'd level out where you were before. But the fact that we've kind of just leveled prices up, and you just know the house down the street is 40% higher than it was pre-pandemic.
And will be forever.
And it just will be.
Yeah.
We've
Yeah.
leveled it up,
Yeah.
and that's the money we spend into
So
existence.
let's come out of this and go back to your point, which is that bonds have priced in an entire easing cycle. So you have this great chart showing that the 10-year has already discounted a cut cycle. Warren, for people that are listening and not watching, what are we looking at?
Yeah, this is what I was saying, is that there's a spread that historically exists between Fed funds rate and the 10-year, and it's about, depending on when you start measuring it, 120, 140 basis points.
Where the 10-year is
Positive.
above.
Normally
Yes,
positive.
yes, positive.
The term
10-year
premium.
Well, yes, you could call it term premium. You could call it whatever you want, but it's just a spread, And we're at the moment, Fed funds rate's 5.5%, 10 years at 3.8%. But when you look through this cycle and you look at the Fed's SEP and you look at what the Fed's saying, they expect to get back to 2.5% by like 2026. It's their long-term median dot within their dot plot. So at 2.5%, and you put on that 140 spread that you're supposed to be at, that would give you a 3.9% 10 year. So
We're there.
from that perspective, we've already discounted that
It's
entire
amazing.
cut
so,
cycle.
So that's the market of buyers and sellers getting to that endpoint on their own in advance, and just betting that that's going to be the longer term outcome of whatever the Fed is about to do.
Yeah, and the bond market has been more pessimistic this whole entire cycle.
How
And
so?
I mean, the other
Well,
side,
we inverted and stayed that way. That's as pessimistic as you could be. in the bond
inverted.
market,
Yeah,
right?
we've inverted, but also like we don't have charts on it, but we would measure the spread between the 1 year forward and the 1 year, which is a whole mouthful, but it's basically looking at the bond market is priced in for month 13 to 24 versus the current 1 year. And that's another proxy for how many cuts are in the market. And we hit all-time lows in that spread. So basically the implied yield from month 13 to 24 was like 170 basis points below the 1 year for all of last year. So we've never, we have a chart on it, but basically we've never seen that going all the way back to the 70s.
The 2-year is significantly below the Fed funds rate too.
Yeah,
Like,
that's
front running it too.
that's where how you imply this rate. So if you look at the 1 year versus the 2 year, you can basically imply from that spread what the 2 year implies for that.
Where's the 2 year now?
4.2.
Which is crazy.
Do you believe the adage that the Fed ultimately follows the 2 year? Like Fed funds overnight rates will get to wherever the 2 year dictates?
They usually do.
Okay.
We've done that study. They usually do, but I don't think.
But it's not that they're not looking at the 2 year. It's the market. The market's telling them where they're going to go.
The market is leading
Yeah.
policy, but
Yes.
policymaker is not as fast as day-to-day action in the bond market. Why should it be? So it takes its time.
And the bond market's been, I mean, the bond market was priced, and this pricing really got ramped up after the bank crisis last March. And so the fact that we've kind of come through that, the Fed put the BTFP in place, and we're all talking soft landing now, tells me that in this case, the bond market was not right. The stock market was
So
right.
let's go back down the rabbit hole for a second. You have a chart where you say the Fed has become a permanent fixture in the bond market, and you're showing that the Fed will end QT balance sheet larger than when it was at the peak of QE3. I feel like people talk about this all the time, like smart people, but could you, like for the regular person, what does this all mean?
Like quantitative tightening, why does it matter? Why does it affect
Like
the markets?
the balance sheet. Why is that so important?
Well, I mean, some people say it's not important.
She's taking a picture.
Okay.
I want to make sure I'm smiling.
All right.
I'm not smiling at the QT.
I was going to say this is a great topic for
All
that.
right, go ahead.
Anyways, yeah. Some people would say it doesn't matter. I mean, that goes back to our last conversation. Some people say, who cares what the Fed balance sheet is? But what I'd say is, and Waller talked about this here recently. He said, like, there's no known number for where the balance sheet's supposed to be. But what I would point to and say, something's changed in the economy. We started QE after the global financial crisis. The Fed's balance sheet exploded up as a percentage of GDP. And after each subsequent crisis, we add a bigger percentage of bonds to that balance sheet. And at the end of the crisis, we're higher than we were at the peak of the last crisis.
I thought QT was supposed to be bearish.
It is supposed to be bearish, but that's
why it's
there's
bullish.
a whole bunch of reasons why it hasn't been transmitted. But that's another one of those debates. A lot of people, especially there's some smart rate traders who'll basically say you're ridiculous if you bring up QT and this QRA stuff and all that stuff.
Warren, the Fed's balance sheet, for context for the listeners, viewers, was like 20%-ish of GDP prior to all the stimulus they did. So when you say it exploded, it goes almost to 40% of GDP. And we've since now retraced, and it looks like, based on your chart, what is this, 30-ish?
Yeah.
28-ish?
Yeah.
28% of GDP.
So if you
but
don't
you're
think-
saying like there's no magic number or rhyme or reason why it should be so then why do we look at it as a percentage of GDP?
I put it that way because you have to normalize it, because the balance sheet's always increasing. So QE, they're buying bonds. QT, they're rolling bonds off
But
their
the
balance
economy
sheet.
is getting bigger.
The economy's growing too, so you have to kind of account for
Okay,
that.
got it.
So those are that's the two things we're looking at. And you can see QT, because the line goes down.
If you just said it
QE,
in
line goes
dollars,
up.
it's alarmist. If you just said, did you know
Trillions,
the
yeah.
Fed's balance sheet is $9 trillion? People would be like, what? Because they don't know how big the economy is to account for that.
Well, this goes back to the rabbit hole we started on, which I think is going to prove to be really important as we go forward in these years, which is that there's something called fiscal dominance. And this could be a symptom of fiscal dominance. And that's what people are saying we've gone into. And fiscal dominance is when you basically fiscal policy overwhelms monetary policy, and monetary policy can't really do its job effectively.
Don't you think that's the story of last year?
It's looking that way, yeah.
You have Biden talking about we're going to get inflation under control while doling out money to companies that are putting bulldozers out into the field to build shit.
I'll put it another way. And now the Fed's primary tool is hiking interest rates. But when they hike interest rates, when debt to GDP is this high, they're basically spitting money out to wealthy people. So
Well,
it's
I've
like
been saying that for months.
I've
Nobody
heard you.
wants to hear.
No,
Nobody
it's
wants
the-
to hear that.
It's
but
absolutely the truth.
I said the only way to slow this down, inflation, is to cut rates. That's not even.
You said it to Gunlock and he sort of
I said
laughed.
it to Jeff.
He laughed.
Jeff said, "Hey Josh, why don't you have another fucking bacon, egg, and cheese? Why don't you
Was that
leave this
live?
stuff to me?" And I would just say I don't think that's a really big part of the equation, but it is one of those perverse things where people with wealth and no debt are now like basically spending like there's no tomorrow
Well, I've
because
said
they
it-
have a geyser of money.
I've said
in the bank.
perversely that when they start to cut rates, people are going to think that they're tightening because they're getting less money in their savings account.
Well, I mean, there's a whole argument you could make that's like, if hiking rates didn't kill the economy, is cutting rates really going to stimulate the economy? I think it goes back to the Q. That's why I think QT is an important factor. QE, QT, balance sheet policy, because it works on, theoretically at least, the longer dated maturities where people borrow money, where the real economy takes place, where risk premiums are set, and where markets and assets are valued. And so that to me is where that's where you get financial conditions loosening, is when you see things like the 10-year drop from 4.10 to 3.8.
What do you say to the person who says, think about how great the economy was in the 1990s? And our colleague Ben Carlson has been writing on this. Fed funds rate averaged 5% or something during the entire decade of the 1990s. There was a huge round of cuts in the summer of 98 because there were some currency blowups overseas and there was a big hedge fund unwind here. Okay, fine. But outside of that, in the 90s, we weren't sitting around pining away for rate cuts. It just wasn't part of the story and it wasn't necessary. I don't understand why it's all of a sudden necessary now. If you could tell me the specific part of the economy that's screaming for rate cuts, I'd be all ears. The housing market has tons of demand. You may not like what your mortgage costs, but I promise you this, if we have mortgage costs fall by 50%, the price you're paying for that house is going up, Charlie. Like, is that what you really, like, that you think you need stimulus there? Do we have a problem selling autos? Does anyone have a problem selling a car right now? So I don't even understand if you got a rate cut tonight. Oh, what are you going to do now? All right, you got it. Now, who gets the benefit of that? I don't know who it is or who's calling out for it right now.
Yeah.
Commercial RE?
Home sellers.
Commercial or home sellers who are about to sell their house for 80% more than they paid for it. That's who needs a rate cut. I'm sorry.
So
I
Warren,
don't
you
see it.
said yesterday's tightening is tomorrow's stimulus.
Yeah.
Do you think that? So I guess like the $1 million question is, okay, true. We know that. The market knows that. You have this chart showing. So coming into this year, analysts are again optimistic. Consensus 2024 earnings are for S&P earnings per share to rise 12% in 2024. Sales will grow by 5% and margins expand by 80 basis points. The anticipated margin expansion is uniform across every sector. So the chart that we're looking at is margin estimates for 2023, 2024, and 2025. And across every sector, it's higher next year and it's higher the year after. So the $1 trillion question is how much of the stimulus, future stimulus, is already baked into the pie?
In the form of estimates.
And asset prices.
I think that there's a knee-jerk reaction to do that, to say that that's the case. But if you
Go on. I agree. Go on.
If you zoom out 2 years, the market's barely up on a 2-year basis, right? So we just made new all-time high. I'm sure we'll get into those studies too. And so, and then if you look at, there's a chart I threw in there on strategist targets. So if everyone's so bullish, look at what strategist targets are doing. Strategists are at like, for 2024 year-end target is like 4,900, and that's
Love
up.
this chart. We used this a few weeks ago.
Okay, well, that's up from the start of the year. And so at the start of the year was 48.33. And there's another chart that goes with this. I doubt you've shown it before, but it's if you look at the equity performance, whenever this strategist targets are within 5% of the
That
S&P
stock's rip,
500,
no?
yeah, rip. I mean,
So what you're showing, what we're showing for the people that are listening is we're looking at the strategist forecast divided by, compared to the S&P 500. And normally, strategists expect the market to be higher, not lower. And right now, they're basically in line, which tells you that they're not expecting a lot. So I totally agree with you. I think what I just threw out is how much is baked in. I feel like that's the type of thing that somebody has been saying for the last 10 years who never makes any money.
for sure.
It's already priced in.
It's priced in.
Hey,
I
I mean-
I even know the guys that keep saying it.
They've been saying it forever.
Yeah.
Well, that's not priced in. That's what I'm trying to say with this chart, and what I've been trying to is that there's going to be a chase. The average over time. This is career risk. These guys are going to raise their targets. It's going
Or get fired.
Yeah, or unless the market has an imminent collapse, which I don't think. You're really trying to win the lotto.
If the Fed follows the 2 year, the strategist follows the 200-day moving average of the S&P.
Yeah, that's a good.
So
that's a
if
good
it's
rule of thumb.
way above where your year-end target is and it's August, you could either double down or you could say, you know what? My wife kind of likes the house in West Hampton, and I'm going to go 49.50 S&P this year. I don't know. That's the mental math that goes into I don't mean to demean every strategist or say it's all career risk, but there's a huge element of that to getting a price target.
I mean, look at the chart. I mean, they basically follow it. They try and stay 6% above where the
You can
market
see the
is.
chase in the chart.
Yeah.
It's as clear as a
and we
bell.
have a version of this that goes back 30-something years, and it's the same pattern over time. And they always are about 6% above the
Now,
market.
when people will make fun of strategists and they'll show this chart, I'll say, well, what do you want them to do? We're going to be contrarian 24/7? Like, in the end, they're trying to give investors guidance and a framework for how to view what's going on in the market.
Well, the big money is made when consensus is wrong, but consensus is usually right.
Well, I think that's a little bit of that's true when consensus is bearish. I've actually done this with like the AAII and the
So
sentiment
nothing's
stuff.
more bullish than when everyone's bearish.
Exactly. But if everyone's
Yeah.
bullish, that's not necessarily bearish.
Right.
It doesn't work the same way.
I've done
in
that with the
reverse.
AAI, you said?
Yeah.
Yeah.
Savita does that with specifically strategists, and it's as reliable as anything.
So
she
you
puts
learn
out.
a lot more when everyone is pessimistic
Yes,
versus when
yes.
everyone is. Yeah, I agree. All right, so we're going to do a lot more on the market, but before we get there, I just want to do one more thing on the economy that you wrote. You said for soft landing dreamers, the loosening of recent months is picture perfect. So walk us through this chart that's on the screen.
So there are on the screen there are 4 lines, and we centered this all on May of 2023. That's when the JOLTS job openings number peaked. And so what we're doing is we're looking at what has happened in the labor economy since JOLTS, the job opening number peak. So job openings are down 2.5 million. We've seen payrolls, jobs growth of 5 million, and we've seen the labor force expand by 4 million. All the while the red line is continuing claims is flat.
Could it get any better?
No, this is perfect. And if you go back, we don't have the chart here, but if you compare it to the other cycles, this is not a thing like a recession. It doesn't look a thing like a recession. So basically when job openings peaked in 07, you saw payrolls come down right with it and claims almost commensurate with JOLTS.
So even ex post, how do you explain the strength of the economy?
I think it's the power of fiscal spending and the deficits that we're running right now, and we've all underestimated them.
I throw demographics in.
What
Everybody's 29 years old going into this. Now they're all 32. What do you do?
Everybody's 29.
It's the most common age to be going into the pandemic was 29, and now the most common age to be in the United States is 32. What do you do between the years of 29 and 32? What do? You get pregnant, you get pregnant again, you buy a house, refinance a house, you get promoted at work, you make more. I mean, I'm not saying like most things, something of this magnitude probably requires multiple variables to explain it. I think it's an underrated piece of the puzzle. The other thing is, historically, you've had a demographic handoff. The boomers are not going to die that way, the way that their parents died. It's just not going to go that way. And not only are they not going to die, they're also not going to sell their assets. And you could take my word for it, because I manage $4.5 billion of them. And I'm going to tell you right now, most of our clients are not going to spend it all and then die. They're giving the money away while they're alive.
They can't spend it.
They can't spend it. It's growing faster.
People with money can't
than they
spend
can spend it. So what are they doing? They're making sure that the next generation can enjoy it, so that they can watch that generation enjoy it. It's not like, oh, if you're reading this, I've passed away. Here's your inheritance. We don't know anyone doing that. We have thousands of clients. So that element, I think it doesn't look like previous cycles, demographic cycles. Again, it's one variable, but it's a big part of the story. We're talking about what's the $70 trillion that has to be handed from boomers. And we think it's going to be linear, like they're all going to pass away in the same 3-year period. And leave it in their will. None of that is going on. And the third component of that same story is the propensity and willingness to borrow against securities portfolios. Again, there have always been securities-based lending, always. However, never in these numbers. And the multiplier effect on securities-based lending, go pull up a chart of Brunswick. They make every popular type of boat you've ever seen. I think they make Sea Ray. Mm-hmm. I don't know, maybe Crown Line, I'm not sure. That's not a recessionary chart. When the leading publicly traded boat manufacturer looks like that,
Ferrari,
you have to say, well, maybe it's different this time with demography. And maybe all of these fairy tales I was told by Harry Dent about what would happen when the boomers turn 70 is not really how this is going to go. So I think these things get lost in the shuffle, but they're important.
Yeah, I mean, I can't disagree with anything there. I mean, we talked about that there is a housing shortage back in 2021 when we said—
Same story.
Look,
right.
And it is a lot of that on the demand side. That's demographics and delayed household formation from millennials. And that's, eventually that happens.
And these homes, half of them are being bought in cash. How is that possible? That's not millennials
That's
buying
money
houses
going—
in cash.
But the problem
That's
is, Warren,
my story.
Everything that Josh is saying, none of that is in.
You gonna tell me it's all priced in?
None of none of that is in any of the historical data. So you could run models until you're blue in the face, and you won't pick up on this current dynamic.
Yeah, and that's why I always say this is like kind of art and science. And there's only so many cycles. Like we're talking soft landing. There's been we count 4 soft landings historically going back. I mean, that's the first thing anyone says to me. I think it's kind of like a little bit of like that, you talk about memes like the midwit meme is like, oh, what's your in count on that? Well, what's your in count on recessions?
Midwit it's priced in.
Everything is
Everything's priced in.
It's like, of course, that's like table stakes. We all know there's not a lot of data to work with. We get it. But this is what it says.
Yeah.
So getting back to this idea that the Russell 2000 obviously is more sensitive to interest rate moves, you have a chart showing the daily reaction to the direction of interest rate changes since the middle of last year, and it's significant. So when
what's purple? What's green?
Warren, you explain your chart.
Okay, so we have S&P 500, S&P 500 equal weight, Russell 2000 in the mid caps. The blue bars are the average daily return for these four indexes when rates are up.
Oh, this is great.
And purple bars are average daily returns for these indexes when rates are down.
On a one-day basis.
One day, just the
Okay.
average daily.
So the
base
knee-jerk
return.
reaction to rates going up is all of these stocks down to varying degree, and then vice versa on days rates fall.
But
they all
especially
go up.
smaller stocks.
Yeah.
That's just banks, dude.
What do you mean?
That's just overrepresentation of financials in the Russell 2000. That's the whole story.
You think so?
Yeah, it has
'Cause
nothing to do with cap size. Nobody cares about that.
if you go, so you think Russell growth?
No, of
you
course
think
it
Russell
does.
Cap
growth?
versus banks.
No, if you take out the banks, it'll be the same
Yeah,
thing.
it will be. If you do
You think
Russell,
so?
Yes.
pull up Russell growth and see what it's done.
Where's
year-to-date.
Fernando? Get him. Tell him.
Yeah. No, I think it is cap size. I
Well,
think it is.
All right.
here's another good thing. That
Wait. So, but this is a function of the borrowing, the need to borrow that small caps disproportionately have relative to large caps.
I mean,
you think?
that's a good theory.
No, it's real. 90% of S&P 500 debt is long-term fixed. With the Russell 2000, I think it's like 50%. So they are much more exposed to
But
the
wait,
current
what
rate
else?
environment.
What else would it be?
I mean, I have no idea. I think it's just interesting kind of way things are being priced. I think a little bit of just like it's also, to me, it goes back to, you said, who's screaming for a cut in this environment. I think it's-
Well, these are the names that you'll see at first.
In this
Right,
environment, mega cap stocks are money good. They're basically the spread over treasury bonds is nothing.
Oh, you know who's screaming for a cut? New York Community Bank.
yes, exactly.
We'll
There's a
get
few
to that,
people
but
screaming for a cut.
Just probably in the Russell 2000.
You
if
have
I
a
had to
great
guess.
chart showing that S&P 500 stocks are attempting to break out of their relationship with yield. So you've got a chart of the 10-year and the S&P 500, and you've got a scatter plot. And for a lot of 2022, these traded very much in line. And recently, it's not the case.
Yeah, to me, that's a really bullish thing. So our idea is that our base case is we're having a soft landing, that the first Fed cut is in May. Going back to those three ingredients: resilient economy, rapid disinflation, hyper-reactive Fed. We think that's all in place, and that's the base case. So May they cut. If you go back to those four soft landings we can identify, stocks rally 10% in the 6 months leading up to the first Fed cut. That takes us to like S&P 5200 on May 1st, which is when the first Fed cut would be. I mean, of course, there are a lot of things that go wrong, and this is like targets are only worth the paper they're printed on. But I think that's a good framework. That's our framework. And you can look at what's happening in the rates market, and you can basically see a path to that, because we've had this earlier price action where rates have gone from 3.8 to 4.2 until recently, or until just the last couple of days. And the S&P 500 has hung out there. It's broken out to new all-time highs. It's gotten into like plus 4,800.
Right. It's changing the pattern.
Right. So now this is how you would control for it. So if rates pull back, let's say the 10-year goes to 3.5, that's when the S&P 500, I think,
Should advance.
Yes, would make that really
When
big
you
run.
talk to a macro hedge fund, a hedge fund that utilizes macroeconomic inputs, and they're more on the bearish side, what's their pushback to that story?
The bear case has kind of been obliterated, but it feels a little bit like you had Neil Dutt on last
Yeah,
time.
shout out to Neil.
Yeah, and he's really great. I feel like I followed him to a conference in California this year, so we've been kind of following each other.
Okay.
But he said he doesn't like indicator macro, and it kind of does come down to indicator macro, where it's like, hey, yield curve is inverted. Remember that?
Yeah, he doesn't like any of your stuff, he said.
That's fine. That's fine.
No, but wait, what do you mean by that?
I mean, indicator macro is something that you would hear from a bear. So what is like a bear case is like, well, yield curve's inverted. We've never had a soft landing when the yield curve's inverted. I get it. You can look at things like
then you just show him my chart of the boats.
That's right. I mean, it's hard to argue.
Right.
With
So,
the boats.
Warren, presumably Fernando made a really sick chart. I've never seen this before. All-time highs are not bearish. I mean, we've said that a million times, been saying it, we'll say that forever. You have a chart showing the average performance in the year following a new all-time high after a prolonged period of time without an all-time high.
This is crazy.
And this is
nobody would guess that it looks like this.
this is absolute eye candy. So walk the audience through what we're looking at here.
Yeah, I mean, there's this knee-jerk response, like you said, and I have this. I'm a pessimist, and I think part of this is knowing yourself. So, like, I'm pessimistic at heart, and so you have to kind of like do studies like this to teach yourself to get out of that pessimism.
And can
that,
you?
Dude, everyone is instinctively bearish at all-time highs because you're like, what's going to drop?
You're constantly looking around
Yeah.
for what shoe's going to drop.
No, you say this is too good.
It can't.
Yeah,
This can't
it can't
last.
last.
It's
Look,
not sustainable.
There's some people who are you have a lot of like the positive people who come on your show. They're always positive. And in some ways I wish I could be that way. It's not the way I am. And so I have to use the data to kind of coax myself out of this pessimism. And this chart, it kind of goes to
So
that
this
point.
chart, we'll describe this. What you're saying here, and you're going out 250 days from a high, it literally goes from the bottom left to the upper right. This is the S&P 500 performance following an all-time high.
Yeah, going back to 1950, if you've had a period of more than 1 year with no new all-time highs, you make a new all-time high, what happens next?
More.
And basically, yeah, you keep rallying.
When did we make the all-time high? 2 weeks ago?
Yeah.
Nothing's more bullish than all-time highs.
Nobody is under.
But wait a minute.
No, but
This-
people are afraid to say because you sound like a donkey.
Is this a composite or it's an
This
average?
is an average.
It's an average,
It's
not
an
a
average
composite.
of all the cases.
This
since
isn't what it
1950.
looks like. I mean, this is not what the stock market looks like. This is what the performance in percentage terms looks like.
Of all average cases. This
So
is
you're
the
not
average of all the cases.
Okay. So that, I mean, that's
I have a table of all the
Here's the
different
next
stats.
table. So he took all these tables and he mushed them together to get an average.
Yeah.
So I totally get it. So let's give people the numbers
So, basically
from an
there's-
all-time high. Go.
From an all-time high, you're up 15% on average.
What-
There have
when?
been- for 1 year.
1
out.
year, you're up 14 to 15%.
And you
average.
guarantee it.
and you're PG in it.
What's that?
You're going to PG this.
What's a PG?
Personal guarantee.
Personal guarantee. Are you co-signing?
Yeah, I'm co-signing.
All right.
All right. But that's remarkable. Nobody would guess that.
And there's only been one down case. So
What was
it's
the down? What was
Oh,
the?
7?
2007,
Yeah.
which happened. And this is the type of thing a bear would catch on to is like, that was also the only time we made a new all-time high when the yield curve was inverted. So this is the kind of stuff that
dun,
holds you
Oh,
back.
you got a sample size of 2.
Exactly.
To the
There you
bank.
go.
And one other thing that people wouldn't guess is breadth is okay. It's okay.
Breadth is, yeah, that's
you
exactly
say
right.
that 20% of the S&P 500 is making new highs, which is only slightly less than the typical 25% at the average new index high. So it's not just 4 names or 6 names.
I've written on this topic. I wrote on this I think in 2013 when we made the first new high from the great financial crisis. So the October 2007 was the S&P high. I think the Dow was 17,000 at the peak, fell to 6,000, right?
Mhm.
All right. When the S&P made its first high since the crisis in the spring of 2013, I think that's when I wrote this piece, but I wrote about the gambler's fallacy because this is the way we're mentally wired. When we walk up to that roulette table, it's red, it's red, it's red. Okay, this time it's got to be black. We think that the world works that way, when in reality, every spin is independent of the one before it. So we're making new highs in March of 2013, and it's like, all right, that was fun. That was a nice rally. Now it's got to turn. It doesn't have to turn. And they built Las Vegas on this premise. Human beings are searching for patterns mentally. They don't even know they're doing it. But those patterns don't really exist. And that's why it's not, a rickety shack in the desert. It's billion-dollar buildings, one stacked on top of another, because of that human gambler's fallacy thing that we can't shake. So I'm not saying that every new high has to lead to new all-time highs, but what you're demonstrating here is that almost all the time it does.
Yeah, I mean, it just shows it's better than the average 252, which is one
Probably
market
8%.
year, is up 8%,
Yeah.
and you're up 15%. So it's better than your average,
average,
252-day period, and your pullbacks and your ultimate drawdowns in that period are lower than normal too. And so,
Oh, that's interesting.
yeah, I mean, you only one down year.
I love, we were talking about this earlier, that when all of the strategists and economists and managers and et cetera, individual investors are bearish, that's a powerful signal. So you have a chart that shows what happens if you're long the S&P 500 when the strategist forecast is less than 5% above the current S&P 500 versus, so when they're pessimistic, versus what happens when you go long when the strategist forecast is more than 5% above. And what happens for everything else? I assume you're in like T-bills or something?
This is just flat. We don't even put it in T-bills because I don't want to muddy the water.
Got it.
Yeah.
So you're either in the S&P or out of the S&P, whether
Putting the money on your mattress, basically.
Based on whether strategists are bullish or bearish.
Yeah.
And there it is. I mean, for people that can't see this.
You want conservative targets.
Exactly. Because it allows them to chase like that. This is basically.
Because they only turn conservative after things hit the fan.
Right. They don't want to be underwater for too long because it starts, just like Josh had said, it's career risk ultimately.
I want to move the ball a little bit. Let's do presidential cycle. We're approximately, I would say, like conservatively, 10 months from an outright civil war. That'll be fun. We'll have new data for all of our studies. But before we get there, can you describe what the typical stock market ride is like going into that election? We know year 3 is the best of the cycle. That was 2023, held up very nicely, plus 30%. How you doing? What are you expecting this year if we were to adhere to the pattern?
The traditional presidential year cycle is considered to be a positive, and it's a weak first half, strong second half kind of pattern. And so that's the traditional, what the cycle tells you.
Okay. So not yet.
No, not yet. It would be a weak first half, strong. And I feel like I've seen a lot of strategists come out with that. And like the least creative.
When does the weakness come about? February?
It's kind of like a reverse of sell in May and go away. We have a chart on it. It's like it's weak in February and you're weak, basically flat and down, choppy, all the way to like, all the way to.
Oh, there you go.
So this is,
and then it bottoms in June.
Yeah,
that's the 2016 example. You got the in the summer of 2016. The two scariest things were Trump got the nomination for the GOP, and he was so unpredictable, and Brexit. Brexit happened, then Trump happened, and we were just off to the races from June on, almost with like no volatility.
Yeah, that's and so I think that last year was so unpredictable and so many people were wrong and the recession was the consensus trade and it didn't happen. And so we come into this year and unfortunately, what's the human reaction from the strategist group? It's to kind of adhere to the normal. So I want an 8% return. I think I go to the presidential election cycle and I see, okay, weak first half. That makes me feel good because we had a big end of the year rally. So why don't we digest that for a little bit and then we'll rally in the second half of the year.
It's too easy.
It's too easy. I think this market is going to just force everyone in the first half.
And then sell off.
If you want to look for a sell-off, it's more likely to be in the second half of the year.
So I actually think March is going to be a disaster.
Okay.
Why the odds?
No. Well, yes. No. Taxes.
Okay.
I think nobody wanted to sell and pay the taxes. I think the rally caught people by surprise. They didn't even understand how much money they made last year. And they're going to owe those taxes. And I think people are going to access their portfolios for the money more so than usual. I know they do every year. I think that's going to be a pretty good buying opportunity.
You said that on Tuesday, January 2nd, when the stock market was down, it's because of taxes.
I was just joking. Now I'm being serious. No, I do think you'll see fund redemption data prove me right. I think it'll be ahead of what it was last year. I just think that people made so much fucking money last year, like ridiculous amounts of money. Almost nobody expected to make that much.
Duncan, how much do you own your Oatly?
What happened?
How much went down?
What are you even paying taxes on that position?
I'm only down like 40% right now.
Not bad. All right.
All right. I think that this is one of those years. So I don't think it like means anything. If you're a long-term investor, I don't think you do anything about it. But it's just what I would expect.
I think that would show up as a smaller deficit. And that's part of like what we've talked about is like you would see that as tax receipts would go up, the deficit would contract. And so that would make sense to me. I mean, that shows up in that data.
After huge years in NASDAQ stocks, my experience, this is how it goes. You had a flat market in 2014. The year 2000 doesn't need to be rehashed. That's after 1999. I feel like last year was one of those years for a certain type of investor, for a tech investor, an index investor, an ETF investor. They made more money last year than they ever thought they would.
This is where the money market funds come in, and how much of that will be.
We're gonna hit that right now. Actually,
so $8 trillion in money markets and CDs. I keep saying that I don't think that's part of the equation.
$8.8 trillion. Is that crazy?
So, although I kind of am waffling on this because even though I think that most of the money is cash that will stay there, I don't think it's money that's going to come into stocks or bonds. I think that's cash that went rightly from checkings into high yields. But even if I'm right and only $1 trillion comes back into bonds or risk assets, that's still a lot of money.
John,
no?
can you do this Wall Street Journal chart? 8.8 trillion.
So what's your thesis on this
So
one?
wait, hold on. So this is saying money market funds is a little bit over 6 trillion. And to put that into perspective, in the year 2000, it was 1.5 trillion. Okay.
But also to put this into perspective, if you divide this by the S&P, it's not a lot.
I understand, but it's still a lot. The CD is another $2 and change trillion. I don't think the CD money is coming into the stock market unless I'm really off. Do you?
What was the meme? One does not simply what the bond market?
One doesn't simply walk into. It's from Lord of the Rings.
Yeah.
It's a Boromir meme.
When you kept saying the CD, I was reminded of that meme.
I don't think the CD money is coming into Tesla. I could be wrong, but $6 trillion. What are you thinking?
I think it matters. It doesn't have to all go in to matter. It's just it's prices are set on the margin. If the Fed starts cutting rates, reinvestment risk, all that stuff comes on the table. Even then, I had I think it was Scott Wapner asked me about this and said, "Well, Gunlack says that's just going to go into the bond market." Well, okay, if it goes into the bond market, that just pushes that liquidity goes into the system and then out the risk curve. It compresses term premiums, risk premiums. Ultimately, it's
a ripple.
It's a ripple.
Yes.
Morgan Stanley's Andrew Sheets. I guess he's a fixed income PM there or strategist. He's saying we've added $1 trillion to money markets over the last year. Quote, we expect the decline in money market yields to be significant on the order of 300 basis points this year. Returns for high-quality bonds are historically attractive at the end of Fed hiking cycle or the beginning of cutting cycles. That sounds like a good trade to me.
Yeah,
out of money market into quality bonds.
Exactly, but that money will find its way ultimately into the stock market.
No, agree. But I'm saying, like, as somebody trying to allocate, let's say you're in the group of people who took a huge amount of their money and said, "F it, give me 5.5%." Now, what do you do this year? Because you're not getting 5.5% now.
Yeah, lock it in. Lock it. You have to.
So how do you lock it in? You can do what could you do? You can
investment
do
grade corporates are fine. I mean, I think that risk premium are compressed across the board, so nothing is jumping out as like as just a screaming buy. But necessity is the mother of invention. They're all going to move out.
Something. Do something.
They're going to move out because they're.
You don't think they are? Michael thinks that
think
the money's going to be sticky in money markets.
I don't think that people that move their money from Chase to a money market fund are thinking about reinvestment risk. I think it was really slow to leave, and the money didn't leave because rates were so attractive. The money left because of SVB. That was the oil on the fire, and so I think that money is just going to be slow to come out. I really do.
Well, I mean, money market funds, we have a similar chart to the stat you're saying. It's not in the deck, but there 1.2 trillion of inflows to money market funds last year. There were inflows to bond funds, outflows to equity funds. Mm-hmm. So I think that on a relative flow basis, you're going to end up with some reversing that.
But I think that you're right in that even if the majority of the 1.2 trillion that went in stays there, even if some of it comes out, pushes bond prices up, brings yields down, then people go looking for more risk in the stock market. I totally agree with that.
The investment grade corporate person then goes into a REIT. The REIT person then goes into a stock.
And then blockchain, blah, blah, blah.
All right, what does Mark Zuckerberg know that we don't know?
Oh, man, that guy's...
How to build cool technology.
No, dude. He is building a fucking bunker in Hawaii on acres of land. It's fully sustainable, meaning he could ring fence himself in this property with his family. They could live off goat's milk and pineapples, and it's got its own fresh water source. Like, this is the third richest person on earth.
Amazon beat.
Hang on. This is like maybe more consequential than Amazon's.
Nope, up 4.5%.
When you see the third richest person on earth take his family and move to a Bond villain's lair on an island in the South Pacific and set himself up like a prepper, and this is not just a regular billionaire. This is a billionaire who arguably is in the center of all information flowing all over the globe. Am I like being overly paranoid about this? And by the way, he was in Congress yesterday. He looks amazing.
Yeah,
can we put this up? Look at his hair.
Whoa.
He's always had that like
It's always been tight.
He's always had like mom put a bowl on my head and cut it because I was in a rush.
He's letting his Jew for a fly. I like it.
So he looks great. He's got a tan that's from Hawaii. Anyway, do you worry about this stuff?
I've had this conversation. I'm not going to lie. I mean, what is going on with that guy? He spent $100 million on a bunker, which is kind of, but I guess it's all relative.
100 million. Who
it's not
cares?
all relative. He's living there. He's doing jujitsu with like an army of henchmen that he's building on a private island under a skull mountain.
What would you do if you were 30?
This is not theoretical.
But he's how old is he? 38?
He's 38.
38. So he's 38 and he's already done. He's already at the top of the mountain. Now he's like, well, what comes
So
next?
he's building an army of fist fighters.
He's made a lot of people mad.
About what?
So, this is personal protection. This is not
Lindsey
him worried
Graham
about the
said
earth.
he had blood on his hands in this
Oh,
hearing.
I thought. Okay, got it. I thought there was something
So
else.
you think he's there to just isolate his family from potential threats because of who he is?
Maybe.
This feels like it's bigger than that.
Maybe it's
He's-
LARPing Last of Us. I don't know.
He's taking peptides and learning jujitsu. I mean, I can't.
What's with
follow
the are you taking peptides?
I'm not, but I mean,
What's a
I had
You don't
peptides
know?
like the new thing.
Oh,
And
you're not
neighbor's
going to make it, bro.
my neighbor's a doctor, and he's like, he does peptides. He's trying to talk to me about them.
Does it help?
Actually,
Wait,
the sponsor of this episode is a peptide.
does it help you grow your hair back? Because if so, I'm interested.
Me too.
It's not Nutrafol. All right. Anyway, last thing. New York Community Bank blew up this week. It's sort of I bought full disclosure. I bought the stock at 5 and change today.
Good for you.
For a trade. I'm probably gonna wait till it gets to 3 and then sell it. So I listened to the call. It doesn't sound like anything's like systemically broken. It just sounds like they made a bad acquisition that they weren't ready for. But this is definitely now going to be the new bear, because you said the bear case got obliterated. Here's the new bear case. There's never one cockroach, and where there's smoke, there's fire, and who else is holding on to something that they're about to tell us about? It can't just be New York Community Bank.
But it can be.
I'm giving you the bear case. Let me just read this. I don't see systemic issues within their loan portfolio that I'm overly concerned about, said Mark Fitzgibbon, head of financial services research at Piper Sandler. Quote, it felt like this was a cleanup quarter. The company said we're going to rip the Band-Aid off all at once. JP Morgan said the same thing. They doubled down on the stock. They said this is overdone. A few other analysts. I saw Chris Whalen, who really understands the banks. He's long the stock. He's like, it was a stupid conference call, but it doesn't matter. So you worried about this? Are people asking you about this?
I haven't gotten the question. I had a conversation with someone who knows more than me on this, and they echo the sentiments that basically this was a cleanup quarter, and they're
It's
actually
a one-off,
making
just this one company.
This is
So
actually
they-
a responsible move, provisioning for losses. And I mean, I think that this is a little bit of the PTSD still from the GFC that's with us. Like we're going to go from commercial real estate is the new subprime. I don't know. It's all anything's possible. It's not my focus, but
Turn that up.
Wait, let's play this for you.
I'd
Jonathan
say,
Farrow.
For the most part, everything's in the rearview mirror now. So there were a few idiosyncratic bank
And this
failures.
is the CEO of Citizens
that
Financial.
related to the business model and how fast those banks grew, and then the stress caused by the Fed raising rates very quickly. And so I think as the year went on, people could differentiate between the traditional regional banks and
that
how
a
well
piece?
they've managed and been able to
That's
handle
fair.
their interest rate risk. And so deposit pressures eased as the year went on, and so things are starting to feel a lot more normal. So yesterday's announcement on NYCB was a bit of a surprise. I think that's an outlier.
The monster's under the bed. It spooked people, though. You know it did, Bruce. Commercial real estate has been something that's been on people's minds for a long, long time
What an
now.
accent.
Do you think
It's
we
Jonathan
have
Farrow,
seen
folks.
realised the unrealised
All right,
losses
but
there?
so they bought Signature Bank, and that pushes them into a new tier. They now have $100 billion in assets, and it was
They also bought Flagstar, and they're digesting both.
so they cut their dividend and then they took a huge reserve loss for future losses in their commercial space. I think it was like 500 million, a lot of money.
There's another building they know they're going to take a loss on. That's
So-
why the reserve was what it was.
The point is, not knowing anything, just based on what people are saying, it seems isolated to their particular situation.
yeah, that's as far as I can tell. Which is not. I don't have any. This is not. I have no edge here. But you know, it's not. It wouldn't scare me off my thesis. Anything I've said or anything I've laid out for clients. And so, I kind of lean on those experts in this case.
If you were to guess, like, you know how you were saying, like, it's going to be some, like, outside shock hitting the, like, it's not an earnings story like the bear case. It's going to be, wouldn't this be the one, though, where there's 2 more New York community banks in the next week, and then all of a sudden everyone's trying to clear their portfolio out of as much shit
None of that
as they
bullshit
can.
matters because Meta's up 8% and Amazon's up 4%, okay?
Yeah.
You are whistling past the graveyard, my
That's
friend.
what I was about to say. Are we whistling past?
And we've
No.
got Apple coming up.
You are whistling past the graveyard.
And we've got this new show that we're doing where it's called Great Quarter, guys, where we're going to go deep on the 5 big tech names that reported this week and last.
Yeah,
So
look for that on our YouTube channel on Monday.
That's on Monday.
Super Bowl. What do you care? You
Oh,
got
yeah, absolutely.
You got a horse in the race, though, I'm saying?
No, I don't have. I'm just gonna watch.
We're going to play some bets, and the next time we have you on, if you're right, we'll celebrate.
Okay.
Or whoever's right, we'll celebrate. 49ers versus Chiefs. The spread is San Francisco giving 2. Who are you taking?
I'm taking. I think it's a coach quarterback type of deal. Plus, KC has a much better defense than people give him credit for. I'm taking Kansas City.
Taking Kansas City all day.
Yeah.
I don't understand. What are you?
So I'm a very conservative bettor. So here's what I place one bet. I place one bet. So I'll place 13 others, but here's the one that I did block in. So I don't do like plus 300 or plus 3,000 or that nonsense. Duncan showed me a bet that was like plus 28,000 the other day. It was totally wild. So here's what I do. I tease the Chiefs up to plus 8.5. I tease the Niners up to plus 10.5. And I teased Patrick Mahomes and Brock Purdy, their passing yards down to 200 yards.
Oh, you think it's a defensive battle?
No. That's not my point. My point is, so Chiefs plus 8.5, Niners plus 10.5, Purdy and Mahomes over 200 yards, and that's even money. That's how I bet. Now, one of those might not hit, obviously, but I like those odds.
Money line is San Francisco minus 128, Kansas City plus 108.
I mean, Kansas City has the value.
So put up 100. Put up 108 to make 100 on Kansas City.
I don't know how you bet against Mahomes in this situation. I hope the Niners win, but I don't know how you bet against Mahomes.
What do you think the game comes down to?
I think that I just think it's going to come down to the coach and the quarterback. I mean, they've got so much experience, and you got Brock Purdy, who's basically
More so than how the defenses play.
I think KC's defense is way better than people realize. I think the Buffalo KC game was the real Super Bowl to me. I think those are 2 best quarterbacks, 2 best teams.
It was so much fun.
I love
that.
I think it could be a big Pacheco game.
Yeah.
Niners are soft in the middle. They've got these great pass rushers.
They haven't been playing well. They kind of skated by in both their.
Aaron Jones ran all over them, and so did Montgomery.
49ers are 6-0 straight up as favorites in the postseason since Kyle Shanahan has been coaching.
Kyle Shanahan is a great coach.
But
say more.
But Kansas City, Mahomes is 10-1-1 against the spread in his career as an underdog. So something's got to give.
All right, I would take the points without any hesitation. Maybe I'm missing something because I'm not a handicapper. I wouldn't know any better. I think that Patrick Mahomes. By the way, if you're not from the Bay Area, I don't know how you would be rooting against Kansas City. Why would you be rooting for the 49ers?
Why am I rooting for the 49ers?
Yeah, what do you care about?
I like the Brock Purdy story. Guys, was still living in
he already made like far beyond anything that he should have done.
No. People are not giving him the credit that I think he deserves. They say he's a systems quarterback. I disagree. And it's enough of Mahomes.
Okay.
I mean, he'll get 4 more rings. He could take a break.
I was going to say, let me give you the other side of that. Patrick Mahomes is the best living athlete currently playing his sport as he's playing it right now, meaning not his season 4 years ago.
What does that have to do with anything?
How do you root against that in the moment? It makes no sense. It makes
He'll win
no
4
sense
more
to me.
Super Bowls. I want Brock Purdy to have
greatness.
I love greatness.
Because first of all, what's the hardest position to play in every sport? Any sport? Quarterback. Period. Like nobody would disagree with that.
Hang on, I'm not hating on Mahomes.
I'm not saying you are.
I want to give Brock Purdy.
I'm making the point that if you don't specifically care about the 49ers, why wouldn't you want to see this guy get his 3rd ring? Andy Reid get another ring. This is like true greatness we're witnessing.
Did you always root for Brady?
I've always rooted for Mahomes. I did not ever root for Brady.
Yeah.
It's the same deal.
Thank you.
I didn't ever root for Michael Jordan. I always rooted for the Utah Jazz back when I was growing up.
I
But when
hated
you
the
watch
Jazz.
The Last Dance,
I was
when
a
you,
John Stockton fan.
when
I
you watch
hated
the
him.
Jordan stuff now, though,
he's awesome.
do you look back and
No,
say, man,
yeah.
I should have been rooting for him the whole time?
But that's part of what makes it fun. Is you get at the
I'm
end,
with you. It's fun to root against greatness.
and you realize like, oh man, that was great. But I did like Brady, but I also think I could understand. I mean, Brady had Belichick in a defense, and I'm not 100% sure that Mahomes, like
he
his
finds a way. He will
look,
find a way.
he's great. But if you're starting a team,
There's a but.
I would consider starting my team with Josh Allen. That guy physically, to me, is.
Can you picture a world in which
If you
this-
put them on swap teams, he would have. I think he'd be.
Can you picture a universe in which this doesn't end with Taylor Swift and Kelsey kissing at midfield and Patrick Mahomes like being carried to the podium? Like I almost can't picture it after this whole season. It's almost impossible for me to picture like what they like sneak away into their limos. I just can't see that's how it's
But
going to go.
Didn't you see Kelsey throwing away Justin Tucker's helmet before the game the other day? I don't think the Chiefs are as likable as
People are
as maybe
turning
you're
on them.
giving credit
People are
for.
turning.
Yeah.
In fairness, Justin's a kicker. Do we accord these guys the same amount of respect as
He was
we-
being pretty
Justin
annoying,
Tucker
too.
and he was
deserves
being
respect.
and he was being kind of a dick from what I read. I wouldn't know.
Best kicker ever.
I don't know. This feels like it's going that way.
So what's our bet?
I'm telling you, follow the smart money.
So what is? I don't even understand your bet. Your bet was
So I do alternate spreads.
so then like
real degenerate
all
shit.
of those things have to hit,
But
and
it's
then
all,
you
but,
basically
but,
are
all right, but tell me
even
which
money.
one of these doesn't hit. So the Chiefs are not going to lose by more than 8.5 points. They're
Right.
plus 8.5. Okay.
Yeah, I don't
Unless
think
there's
so.
like a disaster.
I would
okay.
take that.
Is Patrick Mahomes going to throw for 200 yards?
Yes.
Okay.
Uh-huh.
So those I feel very confident in.
Yeah.
They don't win if he doesn't do that.
Now,
not.
can
Right.
the Chiefs beat the Niners by more than 10 points? Yeah, I guess they could.
There's a universe where they do.
There's a universe where they do. Could the Chiefs win 31-17? Sure. And then the fourth part of the fourth leg of that bet is Brock Purdy over 200 yards. He's going to throw for 200
But
yards.
why do you tease all those things to increase the payoff or to reduce
No,
the
I'm not
risk?
looking to increase I'm reducing the risk. So it's
Okay.
only it's that bet is like plus 109.
Okay. All right.
But what I'm not looking to do, I'm not looking for a plus 300 bet. Like I'm not an idiot. I'm only a moron.
What's the over under?
0%.
What's the over under on the?
It's 47.5 points. I think.
Well, no, I was going to say on the number of kisses at midfield between Taylor Swift and Kelsey. We could bet on that.
47.5 points over under. What do you take?
I'm going to take the under.
I'm going to take the over.
Okay, that can be our bet then.
Yeah. Not because I think Brock Purdy's going to shoot the lights out, per se.
You know what? He's had a rough. I mean, he had a great final drive, obviously, but he has not had a good playoffs.
He has.
Like he really
But
hasn't.
Debo will be in better shape than he's been in since let's say November.
They should have lost.
Yeah,
to the
but
Packers.
low key, I think
Packers beat
McCaffrey
them.
hurt his neck last game a little bit. He's a little dinged up.
McCaffrey's a tank.
saw when he-
Low key, McCaffrey's a tank.
You saw at the
And
end of the game where he
That's what I'm talking
landed
about. He
on
spiked on his head and he never
That
went
was
back in.
Do
wild.
you think
Yeah.
this is going to be a great Super? I think this is going to be one of the most watched ever, and I think it's going to be a good game.
I'm excited for it. I
I'm
mean,
really
If you think it's gonna be a good
entertaining.
game, you like my bet.
I like your bet because
Thank you. It's a good
you
bet.
know more about all of the steps along the way in that bet than any of us do. I just like how excited you are.
Very excited.
Duncan, what are you thinking?
Points, I would do the over.
Sean, do you like
the
my bet?
over?
I just told Sean I think Christian McCaffrey could have 3 touchdowns.
What are you guys doing? Your own podcast in the corner over here? What do you mean? Say it to the group. What did you say? How many?
3 touchdowns for
But
Christian
the
McCaffrey.
thing about
man.
betting and the thing about the markets is everything is priced in. So I'm going to so Christian McCaffrey to score touchdowns like minus 250. I'm going to the Knicks game tonight. So when I go to the Knicks games, I bet on like player props and all that shit. Jalen Brunson to score 30 is like minus 300. There's no juice anymore. Markets are super efficient everywhere. You don't see the odds in the market when you're buying at Amazon. You don't see the odds. You see the odds at games, but markets are very efficient.
While you're at the next game, you know what I'll be doing? Do you know?
I don't know.
I'll be at Coco Dak.
What's that?
That's the new hot shit Korean fried chicken place.
Oh, how'd you get it?
The owner of Coat.
You going with Dan?
Oh, better. Mrs. Dow Jones.
Okay. Better.
Just kidding. Shout out to Dan. Going with Haley and whoever else, but we're gonna do some fried chicken and champagne. It seems like that's a good mix for me, right?
Top. Top.
This is a fried
Take
chicken
it all
restaurant
I
that
take it
opened.
all back.
I take it all
back.
This place it's in Nomad because of course it is, and it opened with a red carpet premiere. Models, movie stars, rappers. It's literally
Holy
fried
shit.
chicken and champagne.
So before we get out of here, Meta's
So
up,
toppy.
Meta's up 12%. Amazon 12%. What did they say? Amazon's up 4%.
It's the presidential cycle, motherfucker.
What did they say? Listen to great quarter, guys, to find out.
All right. Hey, we want to thank our guest today, Warren Pies. Just absolutely charts out the ass was an understatement. We so appreciate it. Where can people follow you and learn more about 314 Research, Warren?
314research.com. Enter your information. If you're an institutional investor, we'll get back to you on Twitter. Warren Pies at Twitter, 3F_.
I believe it's called X.
X, sorry.
Okay, what's the handle on X?
At Warren Pies and then at 3F_research.
All right, dude, you're killing it. I love seeing you
Really
on TV.
appreciate
You're a volume up guy for me.
Oh, thank you,
When I
man.
see you on Yahoo Finance or CNBC, I'm volume up. Let's hear what this guy's thinking. So I so appreciate you coming. Shout out to Fernando. We'll see him next time for sure. And hey guys, thanks so much for listening. Make sure to leave us a rating and review. If you love the show, just know that we love you right back. All right, that's it from us. See you next time.